Let us understand some basic terms in accounting. The first term that we are going to understand is assets. Assets are things of value owned by a business, or a more refined definition can be economic resources expressed in monetary terms. Resources like land, building, machinery, cash, they'll work for business. They help in increasing the earning capacity of the business. They have certain value. They are owned by the business. So they are assets. For example, I'm writing the examples here. Land. Land has some value. Land is an economic resource. So it is an asset for the business. Machinery. Machinery has certain value. It has certain use to the business. That is why it is an asset for the business. Cash. Cash is another example. It has monetary value which is of great use to the business. Hence is an asset. Assets can be broadly classified into two types. They are fixed assets and current assets. What are fixed assets? As the name suggests, fixed means something for a long period of time. They are the assets whose worth would be realized over a longer period of time. And by longer period of time, we mean more than 1 year. More than 1 year. What are current assets? Assets whose worth would be realized within 1 year. Within or less than 1 year. Let us take a few examples. Land. Obviously, if we are not a property dealer, if we are a manufacturing concern or a normal business other than property business, we purchase land for long-term use. We erect buildings for long-term use. We purchase machinery for long-term use. They are the assets whose worth would be realized over a long period of time. Any machine would per se last for more than 1 year. A large machine, boilers, plants, they have life of 8 to 10 years. So they would be called as fixed assets. But assets like stock, debtors, they have life of less than 1 year. Their worth would be realized within 1 year. Hence they are called as current assets. So just to recapitulate, assets are economic resources of an enterprise which can be expressed in monetary terms. Let us move to next definition. That is liabilities. In very simple or crude language, we can say amounts payable by the business. Payable by the business. Something that you have to pay. You take a loan and you have to repay it, so loan becomes a liability to you. You purchased goods from Ram. Purchased goods from Ram on credit. On credit means that you will have to pay Ram at a later date. So Ram becomes your creditor, which is a liability. Just like assets, liabilities can also be divided into various subcategories. Like we can have long-term liabilities and short-term liabilities. Short term can also be called as current liabilities. The criteria for the classification remains same. That is, any liability which is for more than 1 year, would be called as a long-term liability, and if the payment is to be made within 1 year, it would be called as a current liability. Let us move ahead to next definition, that is capital. In simple language, capital is money invested by the owner in the business. Invested by the owner in the business. The money that owner brings into the business is called as the capital of the business. Now, take an example. I'm not saying that this is true always, but for a newly started business, Ajay starts a garment business. Garment business. He purchases a shop for rupees 20 lakhs. Furniture costs him rupees 5 lakhs. And stock of goods costs him rupees 7 lakh. The total comes to 32 lakhs. So this is the amount that he has invested in the business in the beginning. So his capital in the beginning would be 32 lakhs. That is the money invested by the owner in the business. Let us move to next definition, that is drawings. Drawings are amounts withdrawn by the owner for personal use. Any amount of money withdrawn by the owner from the business for personal use. Now, what is most important here is personal use. Let us understand this with the help of few examples. Let's say Ram, he's an owner of a particular business. He withdraws 20,000 rupees for AC in his house. Now, since the AC is installed in house, that means private use. It would be categorized as drawings. He purchased a motorcycle for his son out of the money of the business. That motorcycle is for the personal use of the son. That is why it would be called as drawings. If the owner pays the fees of his school children from the accounts of the business, now the fees of the children is the personal liability of the owner. He has to take care of it. It is not the concern of the business. So that fees that he has paid would be taken as drawings. So in short, amount withdrawn by the owner from the business for personal use. Mind it, it is amount withdrawn from the business for personal use. Then coming to next definition, sales. Sales refers to sale money generated through transfer of goods or services. That is, you are producing, let's say you produce fans. So the money that you generate by selling those fans would be counted as your sales. It is the revenue. We can also call it as revenue generated through transfer of goods or services. In case of industries which are not producing physical goods, it would be sale of services like consultancy firms, like hospitals, But in case of manufacturing industries, fans, ACs, TVs, it would be sale of goods. Let us move to next definition, that is expenses. What do we understand by expenses? Expenses are sums incurred to effect sales. Right. So they are the sums incurred to effect sales. They are the money spent on producing goods and services. Any kind of goods that we produce, any amount of money that we spend on producing those goods would be called as an expense. For example, but raw material, cost of raw material is an expense. Labor expenses, any kind of electricity bills, water bills would be a part of your expenses. Let us move to next definition, that is profits. We all understand profits. Profits in very simple terms imply revenue minus expenses. So we can say that profits reflect the surplus of revenue over the expenses. It is the amount earned by the business and can be calculated by subtracting the expenses from the revenue that has been generated through sales. We'll continue this session with certain more basic terms and definitions. Now, continuing with basic terms in accounting, let us start with discount first. Now, what is discount? Discount simply implies deduction in the value. We can say discount is what? It is deduction in value. This deduction is offered in two different forms. First one being trade discount and the second one being cash discount. Now, what is trade discount? Trade discount is a discount which is offered by the seller to the buyer at the time of the deal so that the deal actually goes through. For example, you go to a shop, you select a particular shirt and that shirt is marked as rupees 1000. This is marked price. MP denotes marked price. Now you bargain and the seller is now willing to discount rupees 100 and the selling price is fixed as rupees 900. So this 1000 is what? This is trade discount. This discount has been offered by the seller so that you can actually afford it or you feel that this product is actually worth at this price. So trade discount is a discount which is offered to effect sales at the time of the deal. Now coming to cash discount. Cash discount is a discount which is offered for prompt payment. Prompt payment. Students, this discount has nothing to do with the deal. This is concerned only with payment of cash. Let's say a creditor has to pay rupees 1000 after 3 months. So the concerned parties, now they come to an agreement, let us make this payment right now. Right now means 3 months beforehand. Obviously, the person who has to pay will seek a discount. That discount is called as cash discount. Or the receiver might offer that if you want to pay today, you can pay 950 rupees. Let us close this deal today by paying 950 rupees. So the 50 rupees is what? The 50 rupees is cash discount. This discount is offered to ensure prompt payment of cash by one party to another. Now, debtors. What are debtors? Debtors are individuals or entities who owe an enterprise an amount for buying goods and services. Now students, this definition makes it very clear that debtors are the individuals or enterprises or entities who have to pay a certain sum of money to the business. And important thing to be considered here is that the payment is to be made for buying goods and services. Let us take an example to understand this definition. Sold goods to Ram for rupees 2,50,000. You are a business and Ram is your customer and you have sold him goods worth rupees 2,50,000 rupees. Now here Ram has to pay us 2,50,000 rupees. Since Ram has to pay us 2,50,000 rupees, so Ram becomes our debtor. Ram becomes our debtor to the extent of rupees 2,50,000 rupees. The exact opposite of debtors is creditors. Let us understand what creditors are. Creditors, they are opposite of debtors. They are individuals or entities who have to be paid by the enterprise on account of goods and services supplied. Now, they are the individuals who have supplied us certain goods and services, and for that particular goods and services, we still have not paid them any amount. Since we have to pay them, they will become our creditors. Let us take an example to understand this definition. Purchased goods from Sohan for rupees 80,000. Since we have purchased goods from Sohan, it clearly implies that we have to pay 80,000 rupees to Sohan. Since this amount is payable by the business, Sohan becomes a creditor to this extent. So Sohan is our creditor to the extent of rupees 80,000. Now vouchers. What are vouchers? Vouchers are the documentary evidence in support of a transaction. Now they can be in any form. They can be a bill, a receipt or any other document which supports that a transaction has taken place. Students, what we have read earlier also, that accounts conveys a lot of information to its users and this information should be reliable. Now, this reliability to accounting information is actually lent through various documents like receipts and bills which provide a proof that a transaction has actually taken place. So vouchers are proofs of any transactions having taken place. Let us move to next definition, that is purchases. Now students, what do we understand by purchase? In accounting parlance, purchase implies purchase of raw materials or purchase of goods for resale. Now why two categories? It depends on the kind of business. Let us say we are into manufacturing business. For example, let us take we are into book printing. Our business is book printing. What are the raw materials that we'll require? We'll require paper, we'll require ink, we'll require binding material, and so on. Now, these are raw materials for printing a particular book. Since these raw materials are directly linked to the product that we are producing, they are covered under the definition of purchases. Let us move to another kind of business. Now, this was manufacturing business. Let us take an example of trading business. You are into trading. Trading implies you purchase goods from one end and you sell them to customers or other businesses. Let us say you are a garment dealer. Garment dealer. You purchase goods from party A and sell to party B. You purchase from A and sell to B. You are acting as a conduit between a producer and the customer. In such cases, the garments that you purchase are purchased for the purpose of resale. So it is also covered under the definition of purchases. So purchases imply purchase of raw materials as well as purchase of goods for the purpose of resale. Let us start with chapter number 1, that is Introduction to Accounting. Various authors, various governing bodies and accounting bodies have defined accountancy in their various ways, and most of these definitions cover probably all aspects of accounting. Let us understand few of these definitions. A very simple definition of accounting is that accounting is a language of business. Language of business. That is very apt because business involves a lot of transactions which are in terms of money. It involves a lot of exchanges of money. So to take care of that, the process that is involved is accounting. Another definition of accounting has been given by American Accounting Association. American Accounting Association. As per this definition, accounting is a process of identifying, measuring, and communicating the necessary economic information to the users of accounting. That is, accounting is an art of identifying. We identify which transactions ought to be recorded. Then we measure them or transform them into terms of money and communicate their result, that is the profits, losses and the other informations, to the people who are interested in accounting. So this involves the complete process of accounting, that is to measure it, to identify it and to communicate the information to the users. But students, probably one of the most widely accepted definitions has been given by AICPA, that is AICPA. It stands for American Institute of Certified Public Accountants. As per this definition, accounting is an art of recording, classifying, summarizing, interpreting and analyzing the transactions which are in terms of money, or which are capable of being expressed in terms of money. So as per this definition, various steps that are undertaken in accounting are covered. It says that accounting is an art of recording. There are n number of transactions which are there in a business in a day. So there is quite a possibility that accountant might forget to take note of these transactions. So it is recorded. Obviously, recording is done not just by merely writing, it is done by applying proper rules of accounting. Then whatever we have recorded is classified on various bases. The basis of classification can be into various accounts or various events. Then summarizing to get out a meaningful information out of classified information. And once all these three steps have been done, then to interpret and analyze the results of these steps. That is, any business is undertaken with the motive of profit. So in this step we calculate profit and analyze how can the performance of the business be improved. And it goes on to say these steps are to be applied only on those transactions which are in terms of money. Students, let us start with objectives of accounting. Now, accounting involves various steps. We have understood it in previous sessions. Now, what are the objectives that are to be catered to by the accounting process? The first objective of accounting is to maintain a systematic record of business transactions. That is, there are lots of transactions that take place with various dealers, with employees, with sellers, with buyers. So to maintain a proper record, that is to record them, to classify them and to make them available in a presentable form is what accounting's main and primary objective is. There is another objective of accounting which is very, very important and is actually linked to the objective of the business itself. That is to calculate the profits and losses of the business. Now we all know and we all understand that the basic motive of starting a business is to earn profits, and whatever we earn can be calculated through the process of accounting. Now this is a specialized step. It involves preparation of final accounts, that is in particular trading and profit and loss account. Trading and profit and loss account. These are specialized accounts that are prepared to calculate the profits and losses that we have earned in the business during a particular period. So we have understood two objectives. First one being to maintain a systematic record of business transactions, and then to calculate the profits and losses of the business. The main objective of the business is to earn profits. So we calculate those profits through accounting. And for this purpose, special accounts that are trading and profit and loss accounts are prepared. Then the third step is, the third objective is to present the financial position of a business. Students, we must understand one thing. To calculate or to earn profits is something very different. And there is a difference in the financial position of the business. Very, very good businesses might make losses in certain years because of certain events or because of certain conditions. They might end up making losses, but that does not make them bad businesses. Take an example. Mr. X runs a business. The business has assets worth rupees 10 crores. In the previous year, he made a loss of 2 lakh rupees. Now, 2 lakh rupee loss in the previous year, does it make Mr. X a bad businessman? No. Probably because of fire, because of any change in economic conditions, he might have made that loss. But when you consider his previous track record, you will find that on average he was making a profit of 1 crores a year. Now, since his average track record is very good, that means the business was good. The business has a sound financial position. It has huge assets as compared to its liabilities. 1 year profit and loss will not affect this business in a major way, particularly when it is a small loss. So, any business should actually reflect upon its financial position, and that is done through accounts. For this purpose, a special business statement, what we call as balance sheet, is prepared. This statement gives a detailed account of the assets and the liabilities of the business, so that we can compare the profits and losses of business together with the financial position of the business. Now dear, next is, it assists the management in decision making. Students, obviously management takes care of all the aspects of the business, but then there are aspects which require special attention. Let us take an example. A manager is actually considering buying a machine and he has two different options before him, and he is an engineer. As an engineer, he is well versed with the technical aspects of the machine, but he wants information from his accountant regarding depreciation, usage costs, and various other aspects which are financially related to that particular machine. So accounting is the tool that will supply that selective information which will help the manager in decision making process, right? So accounting provides the management with the necessary information and tools for making decisions in the business. Then students, accounting also provides information to the interested parties of the business. It provides information to other interested parties. Now, what are the other interested parties? Take a bank. You have taken loan from the bank. So bank would obviously be interested in the financial position of the business. Bank would be interested in whether you have the ability to repay the loan and the interest. So bank is automatically interested in your financial position. So that financial position would be conveyed to the bank through your accounting process or through the books of accounts. Let us understand about various branches of accounting. Accounting as a discipline can be broadly divided into three different branches. The first one being financial accounting, the second one being cost accounting, and the third one being the management accounting. Each of these branches has its own use and its own significance in terms of the results that they produce. Now let us come to financial accounting. Financial accounting basically performs the following functions. It keeps a record of day-to-day transactions of the business. By day-to-day transactions, we understand like sale of goods. It is almost a regular transaction in a business. So it will be taken care of by financial accounting. Similarly, salaries paid, commission received, assets purchased, all these are a part of financial accounting. So the first step is to keep a record of financial transactions of a business. The second step, that it ascertains profits and losses of the business. The final accounts that we prepare, the trading, the profit and loss account, that are prepared to calculate the result of the activities of a business, are a part of financial accounting. The third part is, it depicts the financial position of a business. By financial position, we understand assets, liabilities. All these are depicted through balance sheet, and balance sheet is prepared under financial accounting. The fourth part is it communicates accounting information to the interested users of accounting. Now, by communicating, it means there are various parties which are interested in the accounts of a firm. They are interested in the financial position of a firm. They are interested in the profitability of the firm. They are interested in the value of the assets of the firm. So, such kind of information is communicated to them through financial accounting. So, broadly, financial accounting is that branch of accounting which takes care of day-to-day business transactions, records them, calculates the profits and losses, depicts the financial position through the balance sheet, and communicates the information to the interested users of accounting. Then the second part, cost accounting. As the name conveys, cost accounting means something related to the cost. This branch of accounting is very important as it actually helps in the analysis of cost, and that too for control purposes. Which particular part of our cost is going beyond our expectations. It gives us a clear indication and helps the management to concentrate in checking those areas. The second and one of the very important part is it helps in price fixation. Once we are aware about the cost, it becomes very easy for us to actually fix the prices so as to gather a particular margin on our sales. The third part is management accounting. Management accounting, as the name suggests, it has to do or something to deal with the management. Now, the management of any organization sometimes requires specific information for a particular type of decisions that they want to take. Let's take an example. The manager is interested in purchasing a particular machine. Now, he has two choices, machine 1 and machine 2. What he would require? He would require his accounts manager to compare their cost, to present their cost 1 and cost 2, to provide information about the useful life, then to provide information about the running costs. These are important factors. These factors might not be dealt in detail in financial accounting or cost accounting, but they are relevant only for the purpose of making a decision about which particular machine of these two to purchase. So this kind of information is provided to the management through management accounting. So it is clearly mentioned it provides useful information to the management for decision making purposes. As we know, communicating the information to interested users is one of the very major functions of accounting. Accounting conveys a host of information like profitability, liabilities, their tenures, the payment periods, the assets, their values, the financial position of the business, and so on. So now let us understand who are the users of this information and what kind of information do they require. So now, users of accounting information. The users of accounting information can be broadly categorized into two parts. One are internal users and the second category is of external users. As the name suggests, internal users are the users which are from within the organization, and external users are the individuals or groups or interested parties which are outside the organization. Now, internal users include owners and investors, management, and employees. And each of these groups has its specific requirements or specific interest areas that it looks into the accounts of the firm. Coming to the first interested group, that is owners and investors. Now, owners invest a huge sum of money in the business, and obviously they are interested in the financial viability of the business, the profit that it generates, the profits that they will receive, whether the business is likely to grow or not. So that is why they are interested and deeply interested in the accounting information. Similarly, management. Management takes lots of decisions. These decisions are obviously taken for the good of the business. But what has been their effect, to what extent their decisions have affected the profitability of the business, that is conveyed through accounting books. Then employees. Employees, they work for the business and they are interested in the financial well-being of the business. Their direct interest lies in the profitability of the business to the extent that they will receive bonuses. Coming to external users. Now, external users, there are a host of parties which are outside the business but are interested in the accounts of the business. Let us understand their area of interest as well. The first interested party is banks and financial institutions. Various businesses at various stages of their development require funds, money in terms of loans or in terms of funding. For these funding or for this loan amounts, they depend upon banks and institutions, and no institution would lend money to a business which is not in a good or sound financial position. So the financial position of a business can be gauged through the financial accounts of a business. That is why banks are interested in the financial accounts of the business. Similarly, investors and potential investors, people like you, me, who invest their money, hard-earned money rather, into the shares of a company. Obviously, the share prices bear a great symmetry to the profitability of a business. So the profitability can be judged through financial statements. Investors and potential investors, they look for profitability of a business. Then creditors. Creditors have the same area of interest as banks, but they look for short-term horizons. Whether their money is safe, whether the business has enough financial strength to repay the interest and the amount, and whether the time frames of the loan would be maintained or not. Similarly, government and its authorities. Government has a direct interest, that is through taxes. The taxes that a business pays are in direct proportion to the profit it earns. So government is directly interested in the accounts of a business, as the tax revenue that it would generate would be reflected through the profits of the business. Then researchers. Now students, there are various research organizations, individuals. Research organizations like we have chambers of commerce. They are interested in the financial position of the business, the industry, the economy as a whole. They carry out various surveys so as to reflect upon the strength of an industry, strength of an enterprise. What has gone good for an enterprise or an industry, what has gone bad. So they are interested indirectly in the accounting information. Then we have consumers and public. Obviously, business works for the benefit of consumers and public. So that is why they are indirectly interested in the books of accounts. Students, accounting conveys a lot of economic information. Now, most of this information is in terms of figures and in terms of data. So there has to be a quality about it. So accounting information has certain qualitative characteristics also. Now what do we understand by qualitative characteristics? That is, qualitative characteristics. They are the attributes which actually increase the reliability, the understandability and the information part of the data. Now these characteristics are broadly divided into 4 parts. That is, any decision maker would actually look that the data is reliable. The data is reliable. It is comparable, it is understandable and it is relevant. Now what do we mean by reliable? Reliable means it must be verifiable. Verifiable means, let us say you put an entry that there was a purchase of rupees 1 lakh. Now that purchase must be verifiable. There must be a voucher or a document or a bill that supports that there was a purchase of 1 lakh. that is verifiability part. Next is faithfulness, that is every data or any information that is conveyed must be in faithful manner. That is, it must be intended to convey the same meaning as is actually represented through accounts. Then we have neutrality. Neutrality would mean that any data that is being conveyed should be conveyed with a neutral intent. There should be no personal bias or there should be no inclination so as to reflect the data in a manner that increases the profitability or influences the decision maker's ability. Next is comparability. Now students, the accounting data that are conveyed can relate to various years, and there are institutions, individuals and bodies, they actually tend to compare data on long-term basis. That is, 1 year's performance with the previous year's performance. Then we have understandability. That is, the data must be presented in an intelligent, intelligible and understandable manner so as to convey the same meaning as is actually there. And the last part is relevance. Now relevance means it has two parts to it. One is timeliness. Now as you all understand, the data that is being conveyed should be relevant to the period about which we are talking. Let us say we are talking about accounting period year 2002-2003. But the information that is being conveyed is of 1998. This information is hardly required for calculating the results of year 2002 and 2003. So timeliness is very, very important. That is, the information that is being conveyed should be relevant to the time period the data pertains. Similarly, it must have a feedback value. That is, it must be capable of being up to the mark of the expectation of the decision maker and should have an ability to influence his decision and base his predictions. Students, let us recall various parts and understand the complete process of accounting. As is mentioned here, accounting links the decision makers with economic activities and the results of their decisions. Let us understand this link and how decision makers and their decisions are affected by this process. Students, there are certain economic events. In any business, there are transactions which relate to money. There are events which can be translated into financial terms. Those events give rise to accounting process. By accounting process, we understand recording, classifying, summarizing, interpretation and analysis. This is the process of accounting that we have done. Now, once these transactions are put into accounting process, they are recorded, they are classified, they are summarized and their results taken out in terms of profits and loss and their effect on the financial position of the business. The information that is generated through accounting process is then transferred for information and for the use of decision makers, and the decision makers can be both external and internal. Internal decision makers include owners, employees and the management. They are interested in the well-being of the business, the profitability of the business, the return that their business is going to get or their money is going to get. And employees are interested in the bonuses that they will get. And external users like banks, government, creditors, etc. they are interested in the financial position of the business, the strength of the business to withstand economic events and to survive and grow over a long period of time. They are interested whether the businesses which take loan will be able to repay their debts and interest on time. Once decision makers have this information, they are in an ability to make certain decisions related to their investments and related to the businesses. Let's say the management is satisfied with the working of the company and has an idea or gets an idea that it can invest surplus that is generated over the years into new activities. So once the new events come into picture, again the accounting process will start, again that information will be communicated to various users, and this process continues.